Okay, I am going to record this session. This is for macroeconomics. We probably won't have enough time to debate about this topic because of the very short time we have for class. So instead, I'm going to do this Money and Banking Online. So next Monday, when we meet, we are going to talk about this and we are going to talk about some other issues. So this topic is very important, extremely important, because it talks about the value of money, how money is created, and what is the role of the banking system in the creation of money. So the concept of money is always very ambiguous to us because we know that money, with money we can do transactions. So that's what we know. But what is beyond money? So what is the concept of money? So we are going to learn a little bit about this, and we're going to differentiate about different types of money and how the banks intervene or facilitate transactions in the economy, so the role of banks, and finally how banks create money. So as you remember in our previous conversation, I was talking about the expenditure multiplier. So I was mentioning that when any of the items on the right-hand side of our aggregate demand equation, the fundamental macroeconomic equation, so if consumption, investments, government, or the net exports increase, aggregate demand is going to increase, but the increase is going to be higher than the initial increase. So for example, if consumption increases in $1 million, so the economy, the aggregate demand is going to increase more than $1 million. Why? Well, because the money I receive and I spend, so after I save some of the money, so this marginal propensity to consume, kind of the average amount that the regular person spends in the economy. So this marginal propensity to consume is going to be 95%. So when that happens, out of the million, I'm going to spend 950,000. So the person who gets the money now is an income for them. So he has or she has the same thinking of as me. She's going to spend 95% of the 950. So that money that she spends and then save, that expenditure is going to be the income for another person. So the same money is going from hands to hands, and it has what is called a multiplier effect. So what we are defining is the expenditure multiplier. So money, surprisingly, also has the same multiplier effect. So when we look at how banks create money, the reasoning behind this is very, very similar to the idea of the expenditure multiplier. So we have to keep in mind that money also has a multiplier effect. If I borrow $100 from the bank, that money is gonna go to a checking account. I'm gonna make payments out of this checking account. So the person who gets that money is gonna use it for making more transactions. So at the end, the same money goes from one hand to another and goes from one institution to another. So the multiplier effect of money is very strong. So so that's something that we are gonna comment in the next couple of minutes. So so what is money? Well, in many cases, money has been almost anything. So in other cultures, coffee has been considered money, stones or many things have been considered money. So we have this here, the cowrie shell. So that was considered money for many, many, many generations. So so the question here is this an image of a cowrie shell or money? Well, the answer is both. So for centuries, people used the extremely durable cowrie shell as a medium of exchange in various parts of the world. So you wanted to buy a cow, well, exchange it by these cowries and that is that would consider money in many places. So we have different type of objects that have been considered money before. Um, um, uh, so, so before the money that we know. For example, now we have a bill, we can write a check, we can use our credit cards. So, so we can use our debit cards to make transactions with money. So, so in the past, so people use different things. So in fact, what is money? Money has a very particular issue and so has a very particular purpose. So we are going to define money by its function. So what the world would be like without money? Just imagine that we don't have money, we don't have bills, we don't have coins, we don't have anything. So how do we make transactions? So of course, money is good for transactions. I want to buy a sandwich. I go to the store, I paid either with my debit card, my credit card, or in cash, I buy the sandwich. But what happens if I don't have the money? So what happens in an economy where money does not exist? So I want a sandwich. And of course, my main asset is that I am a teacher of economics, so I can teach economics. So I need to find somebody who wants to learn economics in exchange for a sandwich. So that probably might be very difficult to find. People might not be as interested in the good that I have. So if I was producing milk, for example, probably I will find easier to exchange my milk for a sandwich. So we call that barter. So barter is trading one good or services for another without using money. So the problem with barter is that we need to have what is called the double coincidence of wants. So this is a situation in which two people each want some good or service that the other person can provide. So there are many reasons why this system doesn't work. So you just imagine that you are raising cows and I am growing grapes. So I want a steak. I'm the person who is growing grapes. I want a steak. So you have the cow. So you can produce the steak and I can produce wine. So I give you wine, you give me a steak. So that happens when you and I have the same coincidence of wants. That is sometimes very difficult because probably I don't like, I like meat, but I don't like cow. I prefer pork. So then this double coincidence of wants is very, very, very difficult. In many cases, we might have find out that barter is very difficult to accomplish. So my nose itches, I don't know why. So so that's the double coincidence of wants. It's very hard to make it happen. So that's the reason we have money. Money facilitates transactions. But in fact, what is money? Money is something that has 4 different functions. So in order to know why money is valuable to us, we need to recognize the 4 functions of money. So money, whatever serves society in 4 functions. First, it's going to be a medium of exchange. So whatever is widely accepted as a method of payment. So money basically is an intermediary between the buyer and the seller. I want a steak and I am a professor of economics. So probably not everybody is willing to learn the economics. Probably the best way for me to teach economics is a school. So I work for the school, I get money. So with this money, I can use it as a method of payment to buy the things I want. So I can exchange the services that I provide, which is economics, teaching economics, for a good or service that I want to buy. So in this case, I need money, and money is whatever serves as a medium of exchange. For example, I teach economics, but probably I don't have a job. So a medium of exchange might be some assets that I have. For example, you are a person who is making sandwiches, I can have a gold chain, and probably I can give you the gold change in exchange for sandwiches. So money basically has the function to serve as a medium of exchange. Of course, if I have a gold chain, probably the value is going to be very high for me. It's not going to be very easy to exchange a gold chain for only a sandwich. So this medium of exchange basically is constrained by the asset we own, but can be facilitated by the provision of money. So I work for a school, I get paid, so I get money, and that money is going to be used to buy the sandwich I want. So I have money, and that money is going to be a medium of exchange my services for goods and services that I might be willing to buy. But also, money serves to store value. So just imagine that, well, this store value is something that serves as a way of preserving economic value that one can spend or consume in the future. So for example, I am teaching economics. I just cannot store my knowledge and teach it whenever I need it. So I need to sell this product, my knowledge in economics, and get money. So in this case, I am going to be storing value, and I'm going to be able to consume in the future. So, the only way for me to store value is by teaching and teaching more economics. So I can get money, and that money is going to have the value that I can use for buying goods and services in the future. However, this idea of money as a way to store value, for example, I work for a school, for a school, I get, let's say, $100 in pay. So I have this bill that says $100 money. So that money that is worth $100 is going to be stored in value. Of course, we are not accounting for inflation right now, and we should, because money can lose value and can lose what is called the purchasing power when inflation takes place. So money can be undermined by the influence of inflation. So in many cases, the idea of money storing value is true, but also because that $100 is going to be always $100. But remember that these $100 might lose some value because of inflation. But still, the money is going to be $100. I can say I have $100 in assets, and I need to consider the inflation. So a store of value, something that serves as a way of preserving economic value that can one spend or consume in the future. So, so the third function of money is that it's used as a unit of account. So I make $100, let's say, per hour teaching economics. I can use it as a medium of exchange. I can use this $100 to store value to buy goods in the future. But also that $100, if I go to a sandwich, if I go to a restaurant, I'm not going to use the $100 because most of the time goods have a price. So, and this is good because money is going to recognize different values of goods and services. So it's going to use as a unit of account. So this is the common way in which we measure market values in the economy. So, so I know that a sandwich costs $15 in a restaurant. So that's how much I need for that particular sandwich. So this is, as I said, the common way in which we measure market values in the economy. Every good or service always has a price, and that price is going to become the unit of account. Also, so we can use money as a standard of deferred payment. So money must also be acceptable to make purchases today that will be paid in the future. So, so that's most of the times how money can be considered. So money, once again, has 4 different functions. The first is the medium of exchange, a store of value, unit of account, and a standard of deferred payment. So so those are the ways we can consider value, right? So so for example, this standard of deferred payments can consider some loans. For example, money, of course, can be lended to another person. So it can be accepted to make purchases today that will be paid in the future. So anything that we use, like for example, as part of credit, can also be considered money. So because just remember, we buy, let's say, a plasma TV that is purchased with credit. So we get the good today and we make the plan to pay it, let's say, in a year. So, and of course, that standard of deferred payment is going to accrue some interest. But so the point is, we are going to be able to make a purchase today that will be paid in the future. So only also is not that I need money to exchange, to store value, or to precise the value of a commodity. Also, I can use that money to buy things today and pay that money in the future. So any money that can do that, so or any commodity that can do that is going to be considered money. So we have different types of monies. For example, one of them is the commodity money. So an item that is used as money, but which has also value from its use as something other than money. I think the book makes an example of gold. Gold can be used by money, as money. So you want to buy a property and you have 5 big pieces of gold. Yeah, probably you can buy some property or you can buy some goods by exchanging gold. But also gold is not only used as money, it can be used, it has so many applications in life. So we can use that commodity gold as money because you can trust that money has some value, right? So you have a coin made out of gold. Of course, the price is going to be higher. So you can exchange that gold for other merchandises or for money itself. So in many cases, this commodity gold, as the countries that we were mentioning at the beginning, so many people use it as money, or sometimes they were used as precious things, right? So so the commodity money, once again, are items that are used as money. So it's not a paper bill, it's something else that we use as money. But at some point, we have commodity-backed currencies. For example, I think during the 1900s and the 2000s, early 1900s or late 1900s, so most of the commodities, most of the money, most of the bills were backed up by gold or another commodity. For example, you want to buy a cow, so you get your money and you buy the cow. So the farmer can use the money as money, or they can go to the bank and say, well, I don't want your money, I want my gold, or I want my silver. So those commodity-backed currencies are paper money that are backed up by a gold or another commodity. The gold standard has been something that has been used for many years. So this gold standard basically means that any money is going to be backed up by gold. If you heard the latest news, I guess President Trump, I guess he appointed a person who was supposed to support the gold standard. I mean, I'm not really sure that was a very good choice, but having a dollar that is not backed up by anything makes the value of dollar probably uncertain in the long run. I don't know, probably that was not a very good idea, but because of the rising, the rising debt, I think having a currency that has a support might not be such a bad idea. But so many people thought that that was not a very good idea, and I think I think even the Senate, in the Senate, even the Republican senators rejected the idea. So so then we have these commodities backed up by some type of commodity. So during history, during much of its history, gold and silver backed the money supply in the United States. I think it was until 1970, I think before 1970 and throughout the 1900s, and so 1970 and before, so the dollar was backed up by some commodities, especially gold and silver. But after the 70s, we have now what is called the fiat money. So fiat money has no intrinsic value. So if you see a bill, so that bill says, in God we trust. So that doesn't have any value. So so if you see that, is because that money is not backed up by anything. So now, for example, by government decree, if you owe a debt, then legally speaking, you can pay that debt with the US currency, even though it's not backed up by any commodity. So dollars are paper bills that you receive because you believe it has a value, and you believe that bill can be exchanged for merchandises that you want. For example, not all the fiat money, not all the money has the same trust. For example, if I am teaching economics here in the US, and the president of the school says, well, Juan, I'm going to pay you in Mexican pesos. Well, probably I will not accept it, because I do believe that Mexican pesos are going to be very difficult to be exchanged for another merchandise. So what if they said, well, we are going to pay you in American dollars? I will say, yes, please, because I know if I go to the restaurant, the American dollars are going to be accepted. Or if they said, we are going to pay you in with marbles, of course, I will not accept that money. So in many cases, this money, this bill currency, this bill that represents a value, has no intrinsic value. So it's just by a decree that the government says that is the legal tender in the country. So the only backing of our money, as I mentioned, is the universal faith and trust that the currency has value, nothing more. So why do you accept dollars? Well, because you know that anybody else in this country is going to accept dollars for any transaction that you want to make. So that dollar doesn't have any value. And I guess I have a dollar here in my pocket. I am always embarrassed because I have no money. But if you see the dollar, so this dollar on the back, it says, in God we trust. So this is $1 that has no any equivalency in any commodity. So as you can see on top, it says the Federal Reserve note. And on one side, I guess here in this area, it says this note is legal tender for all debt, public and private. So we have these dollars, this money that basically this kind of fiat money is what every country has. So is the legal tender for their countries. So they have no intrinsic value. They are not backed up by anything. If you go to the Federal Reserve and I said, I want to cash my dollar, they are going to say, good for you, because that money doesn't have any equivalency in value. So so what makes this money is the faith and the trust that the currency has value. And that is going to be because it's going to serve as a medium of exchange. If you go with a dollar to any store, they are going to say, well, okay, I can accept that as if you want to buy merchandise, you also know that if you have a dollar, it has a value. It has an intrinsic value, or not intrinsic, it has a value that you can use for medium of exchange. And you can buy certain units. You probably need 15 of these dollars to buy a sandwich in a restaurant. So, so that is basically the idea. So this fiat money, very important, because is money created by governments, and that governments are not backing up those values. As I said before the 1970s, the US dollar was backed up by gold and silver, especially gold. But after the 70s, now the dollar fluctuates as much as the demand and the supply of dollars allows it. So there is no restriction. The government can issue millions, billions, quadrillions of dollars that not necessarily have to be backed up by any commodity such as gold or silver. That might not be a very good news for many, because governments can just issue money out of the blue. They don't need to buy gold or silver anywhere. They just print the amount of money that they want. And from my point of view, I don't think that's very good, but that's the way we function in this society. So fiat money, very important term, please keep that in mind. So that's the money that is declared, is government decree that that money is going to be used as the legal tender. So, and once again, very important is what makes this dollar a dollar? Well, it's the faith and the trust that we can exchange that money for others. And some others can accept that money as a medium of payment. So this is a silver certificate. As you can see on top, it says silver certificate. That is 1958. So this is a dollar that if you didn't want that paper because it's ugly, so you go to the Federal Reserve Bank or a bank and say, look, I want my gold. I want $1 in gold. So, sorry, on silver. So that money was backed up by silver. So now, as you can read here, that is not the same. This is a Federal Reserve note. So the Federal Reserve prints money, and they assume that people are going to believe that that money is going to be accepted anywhere. And that is true. That is true. Who doesn't accept dollars? Not only in America. You go anywhere else and you have a dollar in your hand, so you can make transactions. So the dollar is a very strong currency, and that strength arises from the state of the economy. So the US economy has been traditionally very strong. So anytime the economy gets better and better, so the demand for dollars is going to be very high. So and this is good. This is good. So in order to have a stronger dollar, we need to improve the economic performance of the United States. So when it happens, so the dollar is stronger and stronger. So very good for a country, because the dollar is not going to be only demanded by nationals. Is going to be, or is going to be also demanded by people from other countries, which is good. So until 1958, silver certificates were commodity-backed money. So that money is backed up by, in this case, silver. So as indicated in the word, a silver certificate printed on the bill, pictured at the bottom. So today, the Federal Reserve backs all the US bills, but as fiat money. So inconvertible paper money made legal tender by the government decree. So, and of course, it's very hard to change this dollar. I don't think there is going to be another government who's going to say, well, no, we are not going to use the dollar. We are going to use fishes to exchange things with the world. I mean, I don't think that is going to happen. So, so that's a good sign. So the stability of the financial system, we know, is going to rely on the American dollar. So, so this is very important. So once again, I want to super emphasize the term fiat money. Fiat money, money that is not backed up by anything, unless the commodity-backed currencies. This is not backed up by anything. It just relies on the trust and the faith of people that they are going to use it. So as I was mentioning, and this is about the trust, because of course you go to a bank or you go to a place and it says in God we trust, so sure, why not? I can buy a dollar menu at McDonald's with these dollars. So I know that that money can be accepted in many places. But anyway, this is very important because in most of the cases, people have the idea that the dollar has a value or any currency has a value. And I don't want to break your heart, but dollars money has no value. So you cannot exchange the dollar by any precious metals or anything. All you have is a dollar that allows you to exchange your work for commodities or services that you might want. So how do we know how much money we have? Well, first of all, who issues the money? So I was mentioning that is very important. So we have the dollar bill, and on top it says Federal Reserve note. So we have an institution that is called the Federal Reserve System. So that Federal Reserve System, as we are going to learn next time, has different districts. So we have the Federal Bank of New York, the Federal Reserve Bank of New York, the Federal Reserve Bank of Dallas. We have another in San Francisco. So there are 12 different regions. So each one has the ability to issue money as they want. So these Federal Reserve banks are part of the Central Bank of the United States. So the Central Bank of the United States is called the Federal Reserve System, and the Federal Reserve System is organized in 12 different districts that have different Federal Reserve banks. So this big system has some duties like bank regulation, and they are responsible for monetary policy. So we are going to learn later on that the Federal Reserve System can manipulate the money supply. So when they increase money supply, interest rates are going to be lower. Why? Well, because we are just increasing the quantity of money. When you have more money in the economy, very likely the cost of money is going to be lower. So interest rates are going to decline. When we have less money in the economy, let's say the Federal Reserve Bank decides, for reasons that we are going to analyze later, decides to cut short the money supply, so we have less money in the economy. So those who want that money have to pay a higher price for that. So interest rates are going to increase. So keep that in mind. More money in the system and increasing money supply makes interest rates lower. Less money in the system, so that means cutting short money supply raises interest rates, right? So, and this is something that we're going to be repeating more and more, but it's good to know. So this is some of the functions of the central bank. One of them is to regulate the banking system, which is very important. I think I mentioned before that the banking system is almost like the grease in the wheels. So you need the banking system to make this economy to work more efficiently. So banks are good. So, and they have to be regulated, because if they are unregulated, many things might happen. So remember the 1929 crisis, the Great Depression. So that was due because there was some banks that filed for bankruptcy, and many of them triggered some what is called a bank run. People went to the bank, they withdrew their deposits, so that caused a huge disaster in the financial system. So that's the reason bank regulation is extremely important. We're going to talk later when we talk about monetary policy. So how do we measure money? So we know that money is created by the Federal Reserve Bank. So, well, that money is defined based on the liquidity. So remember, liquidity means how fast you can convert money into assets. For example, I want to buy a $1 hamburger. Well, I take my money, I go to McDonald's, I buy it, and I get my sandwich. So that is very liquid. So a second degree of liquidity, I can use my debit card, or I can use a credit card and buy things. So that is very liquid. I am able to transform my money into goods or services that I want to purchase. So sometimes money is not that liquid. Just imagine that you have a saving account. In order to withdraw from your saving account, you have to go to the bank, put it in your checking account, or do it in your phone, right? So it's going to take more time for you to do that kind of transaction. You probably might have a share of Apple, which is, it might have a very good value, but you cannot buy anything with the share of Apple. You have to sell it in the market. So the share of Apple is less liquid than a check or my debit card or the money I have in my pocket. So the Federal Reserve Bank or the Federal Reserve System defines money based on liquidity. And they have two different definitions of money. So the first one is called the M1 money supply. So this is a very narrow definition of money. So this narrow definition of the money supply includes the currency, so the coins and bills that you have in your wallet, the checking accounts in the banks, because you can write a check and buy anything that you want, and in lesser degree, traveler's checks. So those are very liquid. So very likely, if you go to a place and want to buy goods and services, you can pay in cash, you can write a check. You say, look, I have these travel checks, and they can be accepted as liquid assets. So this is the most liquid. It's called M1. So the M2, also this type of money supply, is a broader definition of money. So definition of money that includes everything in M1. It includes the currency, the check-ins, and traveler checks, but also adds saving deposits, money market funds, and certificates of deposits. So you have a COD that you are holding in your hands. So you have to cash it first, but it still is money, because let's say that you want to buy my computer and you have a COD that represents the value that I want to get for my computer. So probably I wouldn't mind to get this COD in a month, let's say. So I can give you my computer, you give me the COD, and that is also going to be considered as money. So money market funds, remember many people have 401ks, so that is also money that is somewhere saved and can be invested at some point. So, so that also represents money supply. So once again, two ways of measure money. So the amount of money that circulates in the economy, that the amount of money that circulates in the economy is called money supply. So we have two different types of money supply. One is the M1, currency, checking accounts, and traveler checks. And M2 is the M1 plus saving deposits, money market funds, and certificates of deposit. So a broader definition or a more specific definition, M1 money, M1 money supply includes the coins and currencies in circulation. So the coins that I have in my pocket, the bills that I have in my wallet. So that is considered money supply. In lesser degree, people have money in their pockets. So most of the transactions nowadays are made with debit cards, or even not even checks. So people are more likely to use debit cards and in some degree credit cards. So those are, so coins and currency in circulation are less and less, but that's a very important component of the money that circulates in the economy. So this is coins and bills that circulate in an economy that are not held by the US Treasury at the Federal Reserve Bank or banks involved. So this is money that people have in their pockets. Many people don't trust banks. They put money under the mattress, and that's the amount of M1 that people have in circulation. But also remember that some people put money in the bank, so they have checkable deposits. They are also called demand deposits. So these checkable deposits in bank that is available by making cash withdrawals or writing a check. So I want to buy a television, I want to buy it in cash. I go to the place, I can either have the coins and the currency in my pocket, I can write a check, or I can use my debit card, right? So traveler's checks, as we mentioned, is also part of money M1. M2, as we mentioned, includes all types of M1, but also includes the saving deposits bank, where you cannot withdraw money by writing a check, but you can withdraw the money at the bank, or you can make a transfer to a checking account so you can use it. So in many cases, savings deposits are in a fixed account. For example, I want to save my money and I don't want to spend it. I know that this money is going to be good for something in the future, so I want to make sure that I don't spend it, so I put it in a fixed account, so I cannot move it before certain period. So liquidity sometimes is more difficult when you have a saving account than when you have the cash in your hands. So also money market funds, the deposit that many investors are put together and invested in a safe way, like short-term government bonds. So in many cases, these money market funds, I was mentioning some investors, mutual funds, 401ks. So they are investing money in safe assets, like shares or in the stock market. So, so that money can also be converted into cash at some point. And the certificates of deposits, CODs or CDs, or other time deposits, so those are accounts that the depositor has committed to living in the bank for a certain period of time in exchange for a higher interest rate. So, so people that, for example, have money and they don't want to risk the money in the stock market, they can put the money in CODs, and then the reward they get is that they are going to get a high interest rate. In many cases, CODs promise you at least to recover the cost of inflation plus a premium. So that's a very good deal, because if I invest $100 today, and then at the end of the year, I'm going to have my $100, probably I'm going to have an interest that exceeds the value of inflation. So that might be good. The inflation is 3%, but the COD pays it pays 5%. So I'm recovering the cost of inflation, and I am also adding 2% in my account. So that money is there in the bank, but it's not gonna be available for me in the short run. So this is the idea. We have money supply, M1, this is M2. So M2 includes M1 and M2. So so that's the idea. So I was reading in the book, and it says that I guess the amount of money, in February 2015, M1, this circle was almost $3 trillion. So that's a lot of money. So, and this was $11 trillion, almost $12 trillion. So between M1 and M2, we had almost $12 trillion. So just consider that money. So we have 11 trillions, 12 trillions, and let's say that the economy was 15 trillions in 2015. So some of the money, so we have less money than the money that we are producing. So what happens is that the money, as we mentioned, has a multiplier effect. So if I have $3 million in coins, checks, and traveler checks, that money is going to be circulating from one hand to another. So that is going to make it, that's going to have this multiplier effect. I'm going to explain it a little bit later. But remember, any money that people have in their accounts, either M1 or M2, so that money is going to change hands at some point in time, and that is going to trigger the creation of money. So, so where does the plastic money fit in? Well, of course, debit cards are like money. So that is your money. So when you have a debit card, that means that you have money in your account. So like a check, an instruction to the user's bank to transfer money directly and immediately from your bank account to the seller. I want to buy a computer, I use my debit card, so that's my money. So in some cases, we use debit cards. So debit cards are a little bit more sophisticated because once again, you are buying something that you are gonna get now, but you are gonna pay in the future. So remember, that was a definition of, or this is one of the functions of money. So one of the functions of money is to a standard of deferred payments. So we can buy things with credit, and we're going to get it today, but we're going to pay it in the future. So in this case, so we have credit cards that immediately transfer money from the credit card to the company's checking account to the seller. And at the end of the month, the user owes the money to the credit card company. So this is a type of a short loan, and that is not considered money per se. So it's considered money when you pay your debt. So that is money, but at some point, that money is still in the limbo because you get the good, but you didn't pay for the good. You are getting a loan. So that means that this loan is going to be paid off in a short period of time. So it is considered money until you pay off the whole thing. And then we have some smart cards that stores value of money on a card, and then one can use the card to make purchases. Some of these are, I guess, less common nowadays. So they can be long distance phone calls. I remember they were very popular many years ago. 20 years ago, let's say, I came to America and want to talk to Mexico or any other country, you have to buy a long distance phone card. Now phones have more features, including international calls, but that's not the case. So these smart cards are storing value, and then they can use for certain specific things. So that might not be a good way to use money, this plastic money, because you just have so one choice for spending. So you can use debits or credit cards for almost anything. However, smart cards are not likely to be used everywhere. So credit cards, debit cards, and smart cards are different ways to move money when you make a purchase. So, what is the role of the banks? So we know that I am working, I teach economics, and I want to buy sandwiches. So what does the bank has to do with this? Well, of course, banks are very important in the financial system, especially now that every single transaction is recorded electronically. Probably in the past, I think you are very young to know it, but I didn't even, well, no, I think I did. So, well, no, I didn't. So in the past, you get money in an envelope. But then things became more sophisticated. Rather than having money in cash, that is very risky for many people. So the system evolved, and you got a check. So you got the check, and you went to the bank and deposit that check in the bank, and now you have money. Nowadays, it's even easier. You don't have to go to the bank. Direct deposit is coming without you doing anything, just filling out a form. So banks are becoming extremely useful in the in performing transactions between buyers and sellers. So I am a buyer. I want to buy things, but also I'm working and I'm getting money. So in many cases, I'm going to use the bank as the intermediary for transactions that I want to perform. So most money in the form of accounts. So most of the money is in the form of bank accounts, which exists only as electronic records on computers. So I was mentioning that many times money is not necessary. So as you can see, it's not very common that you go to the bank and get your money out and then you start making payments. Even if you want to pay your phone, you want to pay your anything, you are using electronic payments. So the bank has a very important role, is part of the payment system. So helps an economy exchange goods and services for money or other financial assets. But also many of these banks are becoming very, very important. So they also incur in what is called transaction cost. So this is the cost associated with finding a lender or a borrower for this money. For example, most of the money that I might have, so I'm going to put it in the bank. So the bank, with that money, they are going to find people who want to borrow money. So that is good, because if I have money and I put money in the bank, what is the incentive of putting money in the bank? Well, basically, I'm going to get an interest rate, right? So if I put $100 in the bank, inflation is 3%. So I get 5% in 5% in interest. So I'm making 2% of money, right? So so that is very good for me. That is very good for me because I can keep the value of my money, but also the bank can make money by lending the money I have to another person. So that transaction cost is the cost associated with finding a lender or a borrower for this money. For example, if I have money and I lend this money to my brother, I don't know if he's gonna pay the money back, to be honest. So I'd rather put the money in the bank, and the bank is always gonna cash that money. So I'm sure about that. So that is the reason I trust the bank more than I probably should trust my brother. So so these transaction costs is always an incentive for me to lend the money with less risk. So the banks bring together savers and borrowers together. Banks lower transaction costs and act as financial intermediaries. So my transaction cost of lending the money to another person is going to be probably lower if I use the bank than if I use myself as a lender. So as I said, I lend the money to my brother, probably he will never pay me the money back. But I deposit the money in the bank and they promise to pay an interest, so probably I will trust that more. So so that's the idea. So as I mentioned before, banks function as financial intermediaries. So those are institutions that operate between a saver with financial assets to invest and an entity who will borrow those assets and pay a rate of return. So the question here might be something that we should use as a reflection. What are institutions in the financial market other than banks that are financially intermediaries? Well, we have many. I mean, I was mentioning this 401ks, so that also might serve as a financial intermediary. For example, I don't know if you know Freddie Mac and Fannie Mae, which are big institutions. They buy secondary loans. For example, I have a mortgage, and that mortgage is owed to, let's say, Citibank. So Citibank doesn't make money in 25 years or 30 years. So what they do is that they process my loan, and then they sell that loan to another to a bigger bank, such as Fannie Mae or Freddie Mac. So so that also is a financial intermediary that we can mention. So in many cases, we recognize these depository institutions. So banks are depository institutions. So those are institutions that accept money deposits and then uses this money to make loans. So the banking system basically is a depository institution, because that's what they are for. Banks are there to make money, and that money is made out on the basis that people put money in their banks, and these banks are using that money to make more money by granting loans. So that's the idea. The savers, people like you and me, might have some money. We put the money in the bank. That money in the bank goes to a person who's going to lend the money. So this borrower probably wants to open a business, probably wants to expand a business. So remember, in our private, in our economy, the basic idea is that savings are going to finance domestic investments. So those savers are making deposits, the banks have the money, and that money is lended to borrowers. So the borrowers pay the money back and then pay an interest, right? So the savers, at some point, they might withdraw their money, but also when they lend that money to the bank, they can receive interest payments. So that's like a win-win situation. Of course, that sounds very easy, but there are many factors that explain why banks are not functioning well. So many banks, especially during financial crisis, I guess during 2008, many banks filed for bankruptcy and they were unable to recover. So what was the reason for that? Well, probably savers were making the deposits. Those deposits were lended to people. People didn't pay back because they also filed for bankruptcy. So they filed for bankruptcy and they put the bank in jeopardy by not paying these loans back. So what happens also is a bank is like any other business. So they operate on the same principles than any other bank or any other company. They have the so-called balance sheets. So these balance sheets is an accounting tool that lists assets and liabilities. So if you are not an accountant, probably you are going to be taking courses on accounting. So so most of this is done through what is called the T account, right? So this T account has assets, assets on the one side and liabilities on the other side, plus equity, or the so-called net worth. So we have a balance sheet. On the one hand, we have the assets. On the other hand, we have the liabilities and the net worth. So if I have $100 here, of course, I need to have $100 here. So the bank, the T account is going to be in equilibrium. So banks have assets and they also have liabilities. And the difference between, so if I subtract the assets minus liabilities, I am going to have what is called the net worth, right? So this net worth also has to be positive. When net worth is positive, that means that the financial bank, this bank or any company is in good position. So I was looking at some financial statements lately, and for example, a company had like $1,000 in assets. They had like 400, like 800 in liabilities, let's say. Let's make 800. So they have 200 in net worth. Is that good? Yes, because assets are 1,000. This is the money that you own. This is the money that you owe. You own 1,000, you owe 800. So the difference is going to be $200. That's good. That's good because it's positive. So if you have 1,000 here and you have 1,800 here, so that number becomes 800 negative. So your net worth is going to be negative if your assets are less than your liabilities. Your company might be in trouble. So a company, any company that has assets greater than liabilities is in good position. The other one might be not good. So, so we have assets, the value item of value that a firm or an individual owns, liability, any amount or debt that the firm or individual owes. So the net worth is the excess of assets values over the above amount of liabilities. So total assets minus liabilities is the so-called net worth. So basically banks have that's the bank capital. This is the bank's network. So the bank's network is going to known as bank capital. So this is an example, very simplistic example. Just imagine that you are the manager of a bank. So I go with my deposits. I have $10 million in my pocket. So as a bank manager, that $10 million deposit is going to be a liability for you because as the bank, that money is not yours. That money is mine. So I'm putting my money there. So you owe me that money. So what they are going to do with this money is that they are going to use some money to buy loans or to provide loans. So they are going to use out of these $10, $5 to provide loans. So that's what the bank does. Somebody else come and say, look, I want to borrow money. Sure, I'm going to give you $5 million, but this is the interest rate that you're going to pay. So when they pay the money back, so part of this money is going to be the $5 million plus the interest that they are going to pay back. But also banks not only provide loans. So at some point they have money, and that money has to be used. For example, I have $10 million, but out of the 10 millions, I am lending 5 millions. So 4 millions, I don't want the money to lose value. So I'm gonna buy some US government securities. So I know that if I have the US government securities, at least I'm gonna recover the cost of money, which is inflation. So some of the money is gonna be kept in a safe place. So this money, of course, the $5 million, I think the person is gonna pay me, but I don't know. Very likely banks are lending money to people that they believe they are going to pay the money back. So in this case, because I have at least $4 million that I cannot lend at this point, I'm going to keep that as some government securities. So that ensures that the money is not going to lose value, probably is going to make little money because these US government securities are providing some interest rate. But let's say that besides the $10, I used to have one more million. So besides the million of the $10, so this is 5 and 4 is 9. So I have an additional million. So that becomes the reserves of the bank. So these reserves are going to be money in cash that banks are going to always keep in order to make the Federal Reserve system happy. You cannot lend all the money because the more money you lend, the more risky. Let's say you lend the $10 million and then tomorrow I come back and I said, I want my money back. You might say, oh, sorry, I lended the money to another person. Just wait for 5 years because I lended the money in a 5-year loan. So I'm gonna say, no, I want my money now. So in many cases, banks are keeping reserves in order to have a little caution in case people start withdrawing money in big numbers, right? So we are going to learn that banks are usually protected by the Federal Reserve System. So this requirement, this reserve requirement is like a safety measure for the banks in order to avoid bank runs. So in this case, going back to the $10 million, so we have 5 million in loans, 4 million in government securities, and we have a reserve requirement of 2 million. So in total, I have assets for 11 million. I have liabilities for 1 million. So the net worth of the net worth of the bank is going to be $1 million. So this figure shows a hypothetical and simplified balance sheet for the safer and secure bank. So they are made in this accounting is made in a T account, so a balance sheet of 2-column format with the T shape formed by the vertical line down the middle and the horizontal line under the columns assets and liabilities. So this is the T account. We have assets, liabilities, and net worth. So in the T, so we have assets of a firm on the left and liabilities on the right. So and at the end, that has to be in zero. So if I have 1,000 assets, I have 1,800 liabilities, I'm gonna have a net worth of 1,000 of 800. So at the end, if I close this account, so this is 1,000 and this is gonna be 1,000, right? So 1,800 minus 800, so this is 1,000. So we always have these accounts in zeros, so they have to be balanced all the time. So reserves, as we mentioned before, in this case, we have some reserves. So these reserves are funds that the bank keeps on hand and that it does not loan out or invest in bonds. So as I mentioned before, when a person puts money in the bank, not all the money is going to be lended. They have to keep by requirement in the vault of that bank. So that is called the reserves. So reserves are funds that the bank keeps on hand and it does not loan out or invest in bonds. So that money has to be there by requirement. So the Federal Reserve, as I mentioned, requires the bank to keep a certain percentage of money on reserve. So this money that we have in reserve is gonna call reserve requirements. So these reserve requirements are set by the Federal Reserve System. They said by law, if you get $1, you have to put in reserve 10% of that dollar. Per every dollar that you receive, you have to keep in your vaults in cash, liquid, 10%. So that is very important because that has a very particular purpose. We're going to talk about this next time when we talk about the Federal Reserve System. So we define net worth also as a bank as its total assets minus total liabilities. As I mentioned before, for financial healthy banks, the net worth has to be always positive. Bank regulation helps the Federal Reserve System to know which banks are complying with that. So any bank that is not keeping that this balance are going to be punished by the Federal Reserve System. So that is very important because unlike any other companies, the banking system is a very key element in the economy. So the healthier the the banking system stays, the healthier the economy is going to be. So if a bank has a negative net worth or depositors try to withdraw their money, so just imagine that you have assets, loans that you are providing, but then people are asking for the money. So that might not be good. So just imagine that can be bad if you have a negative net worth. So that is not good. Net worth has to be positive Like for example, in this case, we have a net worth of $1 million. So with $1 million, let's say that the person doesn't ask for the 10 millions, they want 1 million, 2 million. Well, probably in the short run, this bank can borrow money from another bank to meet these expectations, or the Federal Reserve System can intervene to rescue this bank. So we will talk about this next time because that is very important. So, so just keep in mind that we have this net worth has to be positive, and in case that they have a negative net worth or depositors try to withdraw their money, the bank would not be able to give all the depositors their money. So they are in jeopardy. So, so that is very important because assets are always, as we defined before, so these assets are going to be, like in this case, loans. Some money is going to be in a secure space, in government securities, and some of them are going to be liquid assets that the bank is going to have. So that's very important. Those reserves are very, very important. So how a bank can be in trouble? So, well, there are many ways to for a bank to be in trouble. So one of them is a high rate of loan defaults. So just imagine that people, like happened in 2008, they cannot meet their payments. So what is going to happen is that the bank is not going to receive the money back. And if I am a person who has money in that bank and I hear that, for example, Citibank, people are not paying loans in Citibank, I can read that in the financial section of a newspaper. So the rate of default in Citibank is very high. So I am going to go to Citibank and probably withdraw my money because I would not trust that bank. So in many cases, banks can file for bankruptcy because this high rate of loan defaults. Or in many cases, the asset liability time mismatch. So this is the ability for customers to withdraw bank's liability in the short term while customers repay their assets in the long term. So as I mentioned before, we have like for example, this bank, this deposit that I made of $10 million, $5 million are given out in loans. So let's say this is a 5-year loan. So I want my money back. So probably they might sell these securities and then use some of the reserves, but some of the money is going to be very hard to acquire. So, so that's when banks are in trouble. My money, I put my money in the bank lend the money for a long term. So in many cases, this mismatch in time between assets and liability can be a big issue. One of the strategies to avoid this is that, well, banks are going to diversify their commercial lending. So making loans or investments with a variety of firms to reduce the risk of being adversely affected by events at one or few firms. For example, I'm a small bank. Somebody makes a deposit of 10 million. So I'm going to use 5 million to lend money. I'm not going to lend all the money to the same person. Probably I'm going to lend little amounts of people that I know they are going to pay on time. Sometimes to underestimate the financials of a company and they default. That might be fine because in many cases, banks have some type of insurance that can help. So, but diversifying might be a very good way to avoid banks going bankrupt. So sell some of the loans that they make in the secondary loan market. So that's what many banks do. So many bank institutions, they have these credit, or they are supporting these credit cards. Like, for example, if you, I think last time I went to PC Richards, they offered me a credit card. I said, sure. So so that credit card is backed up by a financial institution. And I'm sure that that bank gets the money, they pay the money, but then they sell that loan to another bank. So that happens in many cases. So banks are intermediaries between the buyer and the seller, but then they cannot wait 1 year, 2 years to get the money back. So they sell that asset in the secondary market. So mortgages also, as I mentioned before, is an example of how companies, banks are selling these assets in the secondary market. So, so they have the liquidity to make more loans. So they hold a greater share of assets. So in many cases, a way to go, like for example, when there is a financial crisis, banks are very happy to buy more government bonds because, or keep the money in reserves. So that is good because you don't know what is going to happen. For example, 2008, there was a big financial crisis, and that was not good. So they can hold greater assets, as you mentioned, probably in securities or in reserves, rather than lending the money to people. So, so this is how banks create money. So remember, the banking system works with, so the banking system is a system that creates money and creates money out of the blue. So this creation of money, once again, has to do with the concept that we revised before, is called the multiplier. So in this case, money creation arises when banks create money. So let's see an example. For example, this is the banking system can create money through the process of making loans. For example, this is the $10 million that the person deposited in the bank. So that goes to the reserves, right? So that's the first thing that happens. You make the deposit in the bank has the money there. Somebody's gonna borrow the money. So somebody comes to the bank and out of the 10 million, they borrow $9 million. But remember, there is a reserve requirement for the bank. They cannot lend all the money because they need to keep at least 10% of the, in this case, 10% in the vaults of the bank, because that is a requirement of the central bank. So out of the 10 million, the Hanks Oro Supply borrows 9 million, 1 million is going to be in reserves. Now, by loaning out 9 million and charging interest, it will be able to make interest payments to the depositors. How my money is going to make money? Well, this guy is going to pay some of the money that we are depositing here. So the bank is going to facilitate the lending, as we mentioned before. They are going to be serving as what was the concept? I think I lost the concept that I was gonna highlight, but they serve as people who are gonna provide the loans, so they are gonna make money out of it. So so this is in a bank. This is the Singleton Bank balance sheet. So this is the first approach. The person makes a deposit. So that is a liability because deposits, once again, are money that the bank owes to the individuals. So goes to reserves. Out of these reserves, $9 million are going to be lent out to Hanks Oro Supply, and then 1 million is going to be kept as reserves. So this alters the Singleton Bank's balance sheet. Now it has 1 million in their reserves because this is required by law, and then and a loan to Hanks Oro Supply of 9 million. So what happens with Hanks and money? So this is my money going to the bank lends money. So what Hanks Oro Supply is gonna do is they either gonna open an account in that bank, or they are gonna transfer the money in their own checking account, right? So that's what people do. You receive a payment, and if your payment is in the same bank, so you just put the money in your bank, If you have another bank, you put the money in your own bank. So what happens here? So I am giving money to the bank. The bank has $10 million. They lend $9 million to a person. So the other person gets the money, and that's how money starts being created. So that person who is borrowing the money, that money has been newly created. So Singleton Bank issues Hanks Auto Supply a cashier check for the $9 million. So let's say that Hank deposits the loan in his regular checking account at the First National Bank. So that was in the first case. So we have the Singleton Bank. Now he puts the money in the First National Bank. Just by transferring the money either in the same bank or in another bank, they are creating money because that is my money that went to his hands. So he's gonna create money because he needs the money to buy, let's say, to pay cost client, to pay workers, to buy supplies. So they are gonna create money. So when Hanks Auto Supply buys new equipment, let's say, they are writing checks and that money goes to the supplier. They have their own bank. So this is my money that went to Hanks Auto Supply and now is going to the hands of the person who is selling them some supplies, right? So that money, my money, is going through different hands, and that is how money is created. How fast the money travels? Well, it depends very much on the conditions of the economy. So the deposit at the First National Bank rises by 9 million and its reserves also by 9 million. So this is so we are going to start. So this is the first step. This is the second step when the bank lends the money to Hanks. And then the third step is when Hanks put the money in his bank and they put the money in reserves. So that money is going to be used by the first bank to provide loans. So that $9 million, they are going to, somebody's online waiting and they say, well, I want money. So they say, well, out of the 9 millions, I can only lend you the 90% and keep the 10% for the required reserves. So so they lend another person 8,100,000 and they keep in reserves the 90,000 out of the $9 million. So that's how money is going from one bank to another, and these new loans are basically creating money. So in the part 3, if Jack's, so that's the second, Jack's Chevy, which is the person who is borrowing the money from here, they open a new account, or they have a new account in the Second National Bank. So it goes from the Singleton to the First National to the Third National. So the same money is going from bank to bank and is creating new money. So that is called the multiplier effect of money. So if Jack's Chevy dealership deposits the loan on its checking account at the Second National, the money supply just increased by additional $8.1 million. So you have the 10 millions, then the 9.1. Now we have the, or the 9 million, now we have the 8.1 million. So in just 3 steps, the 10 million became 1927 point something million dollars. So that's how money, the impact of money is very strong. So every time we make deposits and that deposit and those deposits are gonna be lent out, we are creating money. So making loans are then deposited into demand deposits accounts, increases the money supply. The M1 is increasing, so the amount of money that circulates the economy increases very fast. That is the M1. Remember, M1 includes checking accounts, and they increase very fast because of the multiplier effect of the money. So this money creation is possible because there are multiple banks in the financial system. They are required to hold only a fraction of their deposits. Loans end up deposited in other banks, which increases deposits and money supply. So that increases the deposits first in the Singleton Bank, and then increase the deposits in the First National, and then increase the deposit in the Second National. So that at the end increases the amount of money available in the economy at some point in time. So that's what I was mentioning, the money multiplier and the multi-banking system. So if all banks loan out their excess reserves, so the money supply will expand. So we're assuming that every time money is circulating from one hand to another, that started from a person who has money in their pocket. So he took the money to the bank, so that money is going to start working, so it's lended out to another person, then circulates. So that facilitates the creation of money. So in a multi-banking system, institutions determine the amount of money that the system can create using the so-called money multiplier. So this money multiplier means that banks go move money from one bank to another, so they create more reserves. So the money multiplier is gonna be equal to 1 over the reserve requirement. So in this case, the reserve requirements were 10%. So if we say the money multiplier is gonna be 1 divided by the reserve requirements, right? So if the reserve requirements is 1%, is 10%, 0.1, so this is the 10%, then the multiplier is gonna be 10, right? So the original $10,000, not $10 million that we deposited or I deposited in the bank, at the end of the cycle, it's gonna create $100 million. Why? Because of the multiplier effect. So the multiplier is gonna be 10. So that means that the $100 are gonna, sorry, the $10 million. So let me do this. $10 million. That's an M. It's gonna produce $100 million. And those are the same exact $10 million that I deposited in the bank. Why? Once again, there is a multiplier effect of money when money circulates in the economy and goes from one bank to another. It doesn't create the same effect if I give you the money, I lend this $10 million to my brother. So probably he's gonna be also using cash, so that doesn't generate money creation. But if I write a check, so if I put the money in the bank and my brother goes to the bank and he borrows the money from the bank, so that is, he's gonna use his checking account and the money, the $10 million, he, according to this process, he's gonna be able to lend out 9 million. So that 9 million in the second bank, in his bank, is gonna be borrowed by somebody else. So money goes hand to hand. Once again, that is the multiplier, the money multiplier. And remember, the money multiplier is gonna be found by dividing 1 by the reserve requirement. If the reserve requirements here, for example, in this case, were 20%, not 10%, but 20%, right? So what is gonna happen? So this is gonna be 1 over 20%, so the multiplier is gonna be 5. So if the reserve requirements were 20%, so instead of, if I deposited 10 million, and in the original case, they could borrow or lend money in the amount of 9 million because of the 10% requirement. Now with the 20% out of the 10 million, they are gonna be able to lend out only 8 million. So that means that when the reserve requirements are greater, the multiplier effect of money is gonna be lower, right? So we saw that when the multiplier was 10%, this number was 10. Now the multiplier is 20%, sorry, the reserve requirement is 20%, now the multiplier effect is going to be only 5, right? So at the end of the day, the $10 million are going to become only $50 million. When the reserve requirements were 10%, the 10 millions became 100 million. So by multiplying the money multiplier by the excess reserves, we can determine the total amount of money in the economy created in the banking system. So if we multiply this money multiplier by the excess reserves, so we can determine how much money circulates in the economy. Of course, we usually don't do that. That information is widely available, but that's how the monetary authorities can do that. So they multiply, they don't need to count the money. They just go to the, they compute the money multiplier and they multiply this by the excess reserves, and they can compute the amount of money that circulates in an economy. So, so that's the interesting. If the reserve requirements were 10% and the bank excess reserves were 9 million, so what is the change in the money supply? So we multiply 10% times the excess reserves, 9 million. So the change is going to be 900,000, right? So that's going to be the 10% of that $9 million. So that's the amount of money that is in excess in money supply. If we have a money supply of $100 or of 100 million, and now the excess reserves are 9 million, so given the reserve requirements are 10%, so the $100 million of money supply is M1 plus the excess reserves times this. So the money supply is going to increase in $900,000. So so that's a very good thing to know. So cautions about the multiplier. Of course, this is a very good approximation of how things work in real life. So there are many things that we need to know about this multiplier, money multiplier. So the quantity of money in an economy is very closely linked to the quantity of lending on or credit in the economy. So that is a very good proxy for knowing how much money we have in the economy. So we just go to the quantity of lending or credit that we have in the economy in order to know more information about how much money circulates in the economy. So all the money in the economy, except for the original reserves, is the result of bank loans that institutions repeatedly redeposit and loan. So so that money, so this economic activity is going to be tracked by the governments by just looking at how much of this money has been lent out by banks. So so that's very important, because these computations might be for the Federal Reserve System. They can track the evolution of money supply by just looking at the loans that new institutions are granting and how they are changing from hand to hand. So a bank can also choose to hold extra reserves above the required amount. And that happens when there are many issues that are uncertain. Like, for example, I made a deposit of $10,000, $10 million. By law, they should keep 10% of that money, right? But they said, well, COVID is not, I'm not very happy with COVID. I think the bank is going to reassess how much money they can lend out. So they are going to, instead of lending the money, they are holding as more reserves. So the money is going to be there. They probably will buy more securities, but lending is going to be not good, right? So in this case, reserves, the minimum required is 10%, but they can hold any money that they want. And it depends on many things. So, so why banks decide to hold money in reserves? Well, basically macroeconomic conditions. Like if we look at what is happening in the economy, the economy is not good. So the macroeconomic indicators, they are not extremely bad, but they are not very good as it would be in a healthy economy. So they might decide to hold the money and make no loans for some times, or reduce the amount of loans, but also in many cases, government regulations. So when you see that the banks are being pressured by the government, they have to comply with so many things, so that they are not happy. They might say, you know what, it's not worth it to lend money, so let's slow down the process. So that happens in the period followed by 2008. The monetary authorities and President Obama, they put so many regulations on banks. So they had to comply with so many things. So at some point, banks were not lending money. So government rules can either slow down or can facilitate borrowing in the financial markets. So that's something that we need to know. So in a recessions, banks are likely to hold a higher proportion of reserves due to fears that customers are less likely to repay their loans. So also the Federal Reserve might also raise or lower the reserve requirements by banks as a policy to affect the quantity of money in the economy. In many cases, reserve requirements are not very likely to be moved. We are going to discuss that, but as a potential policy that can happen, of course, when you are lowering the reserve requirements, for example, from 20% to 10%. So now, if you have $1 million to lend, under the 20%, you can only lend 800,000. But under the 10% rule, that is lower than 20, you can lend out more money. And of course, if the bank is willing to lend more money out, they are going to make more money. So the more money they lend, the more profit that they make. So that is good. But it's not good because lowering the reserve requirements from 20 to 10%, the bank is going to be put at a riskier position. So that is a trade-off that happens in banks. Lower reserve requirements increase the profitability of the bank, but puts the bank in a more risky situation. So so I'm going to repeat that because it's very important. So when reserve requirements go down from, let's say, 20% to 10%, so the bank is able to lend out more money. And the banks are going to be able to make more money by lending more money. But also they put the bank in a more risky situation. So, so as the reserve requirements decrease, the amount of profit increases, but the risk is higher. So the opposite is also true. When the Federal Reserve increases the reserve requirements from 10% to 20%, so the bank makes less money, is less profitable than before, but is safer in some ways. So a good balance between reserve requirements is going to make the financial system very profitable and very stable. So, and I hope that helps. I will see you guys next week. And next Monday, I'm going to send this video as soon as I can. And I will see you on Monday. Goodbye.